With everything going on in the economy right now, where do you put your money? What do you do? Let's say you've been in the market, you leave it in the market. If you're putting your money in real estate, you leave it in real estate. Today, we're going to talk specifically about real estate, particularly the multifamily market, but other real estate markets. And we have one of my favorite experts on the line, Brad Sumrock, who is a good friend of mine and somebody that I have relied on for a lot of, particularly in the multifamily space, information. So today we're going to have a conversation about the state of basically the state of the real estate economy. So Brad, welcome to the Wealthability Show.
Hey, Tom, thanks for having me on. It's always a pleasure to be on your show, and I'm excited about what we're going to talk about today.
So just for those who may not know you, most people do, I'm sure, but for those who don't, give us just a 30-second background in what you do.
Yeah, so look, I have two main businesses that I'm really passionate about, and one of them is buying and investing in apartment buildings. And my first investment property ever was not a single family or a duplex or a fourplex. It was a 32-unit building that I did in 2002. And I started with no previous real estate investing experience. And then I quickly learned how buying 60 units and up affords us a lot of advantages like professional management and scale. And so this is what I love to do now. And I'm currently in over 7,000 units. I've had up to 10,000 at one point as a general partner. And so that has been a very fulfilling and profitable venture for me for 22 years. And then over a decade ago, wanting to give back and help people do what I do, I have an event company that does, events, and we do mentorship programs. We have a mastermind. And Tom, you've been at these events and have been speaking at some of my masterminds for like 6 or 7 years. And so this is also something that really fulfills me and has moved the needle in a lot of people's lives.
No, I appreciate that. So let's get into the real estate market. It's been a tough market. There's particularly people who have been invested in syndications or general partners in multifamily. And a syndication, just so everybody knows, that is where somebody who wants to, like a general partner, that's what Brad's talking about, wants to go out and invest in real estate and he needs to raise capital. The capital is raised in a syndication. That's called a syndication. So what's gone on is that there were a lot of loans and a lot of people. In fact, I think you told me once, Brad, about 87% of loans were in variable rate loans. And so basically what's happened in the multifamily market is effectively a repeat of what happened in the single family market in the mid 2000s, right? 2007, 8, 9. Effectively, the same thing happened where we had most syndications were on variable rates. And then all of a sudden the interest rates jumped. And in this case, it was a response to the inflation. I had an interesting guest the other day, Brad, a while back, that said that the Fed's job is they have two mandates. One is inflation and one's employment. Okay, inflation, employment. The government, they can do whatever they want. So there's a complete disconnect between what the government does, which may cause inflation, and then what the Fed does. So the Fed, if the government, say, puts too much money in the market, like they did in 2021, 22, and even some of 2020, then what happens is that if that causes inflation, then the Fed's job is to bring inflation down. Well, they've hit interest rates really hard. As you know, Brad, that's been a lot of pain. There have been a lot of people losing investments. There have been a lot of real estate that is in, frankly, deep trouble. A lot of syndications in deep trouble from people who presumably knew what they were doing. And yet they still got caught by this, the Fed acting so aggressively in increasing interest rates. Interestingly, it hasn't seemed to affect the single family housing market. Those prices are still high, but it's had a huge effect on the multifamily housing market. So recently we had good inflation news. So just give us, if you can, kind of an overview of where you think the market is right now from, from your expertise, multifamily space.
Yeah, so there was a lot there you said, so I'll do my best to try to address that and answer the question that you asked me at the end. But the first thing I want to clarify is, what a syndication is, and you did a great job, but I'm going to try to make it even simpler for people to understand. Is imagine, there's a building for sale for $10 million, and historically we need 20 to 40% down. Where we're at in the season now is it might be 40% down, but it might be 20 in the future, and it was 20 a few years ago. So you need $2 to $4 million, and most people don't have that in their pockets. Some do, but most don't. And so what we do is we create communities and environments of people that are educated and accredited that pull their time, their resources, their money together so they can actually buy a business and be a business owner and investor, going back to our common friend, Robert Kiyosaki, when he talks about ESBI. And so what I like to do is buy apartment businesses and have them professionally run. And we do that with groups of people. So that's how I would describe a syndication. And you're right, like there's been a lot of challenges, and, we could point fingers about what happened, but I think everybody is aware that there was a pandemic. There was trillions of dollars of money that came into the economy. There was inflation, there was rise of interest rates. And the other thing that isn't talked about that much is during the pandemic, all these new development projects got kind of sidelined for a while because nobody was working, and so they couldn't complete them. And so after the pandemic, there was an abnormal glut of new inventory coming in as well. And so, in multifamily, we talk about class A, B, and C. Class A is the newer stuff. And, people like that because it caters to a higher demographic, and higher income level people. But that sector actually got hit harder than the 1970s and 1980s inventory, because imagine, like, during the pandemic, all this development got sidelined, and now all of a sudden in 2022, it's all hitting the market at the same time. And so I have some class A properties, and we had to compete with all these new buildings coming online with like move-in specials and concessions and lease ups. And so one of the places where we're at, Tom, is that new glut of supply is slowing down, and developers, if you look at the number of new development projects, which we call starts in multifamily, and I'm not in that business, by the way, I'm in the business of buying existing buildings, but the people that develop is down 72% right now, okay, across the nation. And so that's good because, things ebb and flow, and there's always market cycles. And so there's going to be moments of time where there's going to be a lot of inventory coming on, and then there's an over knee-jerk reaction, and now there's going to be less inventory coming on for the next few years. And then we're going to see a lot of new development starting again. So it's not like it's not like the ideal situation would be like every year we have the same amount of units coming online. It goes up and down a lot. And as it goes up and down a lot, it impacts existing inventory and, occupancies and rent growth and all that. And then we look at nationwide statistics, and we come to maybe some premature conclusions because, as you know, all real estate is local. So when people talk about like, well, rents are going down or occupants are going down, it's like, well, there are some markets that rents are going up and occupancy is going up. And so one of the things that I try to tune into is like, where are those markets? Like, where are the markets that are overperforming the national averages, and what are the characteristics of those markets? But in general, like, I think we could all agree that we're, in sort of a winter season where, it's a more challenging time over the last few years. But again, I've been doing this for 22 years. And what I have experienced is that multifamily is a great place to be. And it's a great place now because as we come out of this slump, and we have an election too, and so that could be more uncertainty. But whatever happens after the election, where I think we're heading is to a period of stability and certainty. Like whether it's a Trump administration or a Harris administration, we got to be prepared for both. And we talked about that earlier this week on one of my Zoom meetings. But look, I think we're coming into a period of more stability and more certainty, especially after November. There's billions of dollars of dry powder on the sidelines. it looks like they're going to cut interest rates at the next meeting, and there may be another cut before the end of the year. And all of that bodes for, an uptick in multifamily.
Yeah. So let's break some of these specific things down. So for example, I saw the other day a stat that take Austin, Texas, which has been super hot for a long time. And rents have come down, according to this source, by 6%. That there's a glut now. People aren't coming into Austin. It's not growing, even though technology is still the sector of the economy. If you look at the Dow, if you look at the stock market, it's technology that's driving it. And yet Austin, which is a hub of technology, is apparently, what it appears to, is actually losing jobs and losing people. And so here you've got this hot market. And so this goes to what you brought up is, okay, so I would frankly never have guessed that Austin would be the market that dropped. Okay. But apparently there was so much, like you were saying, so much construction came on, so much new came on, that now there's a glut. It's come down quite a bit. And so how do you judge that? I mean, I don't think anybody would have thought 2 years ago that Austin, as an example, would have been the market that would be really dropping heavily right now.
Again, there's like, we talk about national numbers, and then we talk about Austin. And Tom, I know that you know this, but like within Austin, there's like a lot of different variables. So like I was just there Monday and Tuesday speaking in an event, and I took a picture of the skyline, and I see so many buildings that are high rises under construction with cranes on top, in the central business district. And there's just a lot of new supply that's still coming. And so imagine that, Tom, you and I put a syndication together, and we bought a building in downtown Austin that was built in 2012 that's trying to compete with that same demographic. And next door, there's a new building that comes online, and they open up and they're at 0% occupancy, and they got to do a lease up. They're going to be really aggressive on how they're going to fill up that property.
Right.
We're going to lose clients to them because our building was built in 2012, and they have a newer gym and a newer waterfall and a nicer pool and nicer units. And so they're going to be able to fill up that property, and they're going to need to offer concessions and move in specials. And so we're going to have to react to that. And then meanwhile, 20 minutes away in this working class neighborhood, there's a building that's 2-story, it goes this way, not this way. And you go out there and you don't see any new development, and you see, families of 4 that make $50,000 a year. And there's a lot of mixed, ethnic groups. And these are the people that work in the restaurants and the hotels and stuff like that. And these deals are actually performing better. So like, if I were to be looking in Austin, I just wouldn't look at like, hey, here's the statistics of Austin. I'd be looking at what's happening in this neighborhood, in this demographic, in this property class. And that's where the opportunity is right now in every single city. There's opportunity in every city.
I get that. Yeah, I want to address actually some of the challenges, because there are serious challenges going on right now, Brad. There are. I mean, there's. Let's talk, for example, and you've seen this. A lot of these syndications are actually doing capital calls, meaning that they're asking for more money. They're saying, look, the value has gone down so much, because of course value has to do with interest rates, right? Because that's the cap rate formula. So values have come down so much. And if the rents are softening, okay, because there is a lot of supply. So even if there's, I would say, even if there's additional supply going on in downtown Austin, that could take away from outside of Austin. So
a little bit.
Right. Yeah. I mean, even if it's A's going in, it's going to affect B's, because B's like to move up to A's. Okay. So people in class B like to move to A if they can. So if there's concessions, you're going to have that. So my question is, how does somebody look at, if you're talking to somebody and they've got a potential capital call, let's say it's a 25% of their original investment. So let's say they put $100,000 into this investment, and you've seen these and you're seeing them right now, I think more and more. And the developer says, look, here's your choice. You can lose everything, or you can put in $25,000 and maybe get something, but all that's going to cover is the next 2 years. Okay. Because that's what those capital calls are betting on, is that life's going to be different in 2 years. What do you tell that investor? Because the logical, thing every investor's thinking of, am I throwing good money after bad?
Yeah.
So what are you telling them?
Yeah. And I'm going to answer that, but I also want to say, like, there are a lot of challenges, and you hit some, and I don't have a problem saying this. Like, I'm in like 37 deals right now, and I've had 3 or 4 capital calls myself. So like, let's be real here. And, here's how I look at it. And I've been an LP, and I am an LP in some deals where I have to make that same decision. Should I put money into this property? And so, again, we could talk about how that was created with rise of interest rates and stuff like that, and people getting variable rate loans. But it's not just that. Like, I have properties that have fixed rate debt that have struggled. And, again, it's a handful. It's not the majority, it's a minority, but they are challenges that people need to be aware of. And when you get into this business, in fact, any business or any entrepreneurial activity has risks and challenges that people need to be aware of. So like after COVID, and let's talk about some of this after COVID.
So let's go back to this, Brad, if I can. I'm going to pin you down on this, if that's okay.
What am I telling people?
What I'm looking for is, how do you analyze that? Because surely there are some that it makes sense to make the capital call, and there are some that does not make sense to make the capital call.
Yeah, let me just hit that on the head. I know I like to talk a lot, but we got to look at where the deal is now and do a new projection. And to me, that's the best we can do, because a projection is always a projection. It's never a promise. It's like, so we take the best information we have. So like, there's a deal I'm in right now, and we're in year 3. Okay. And so our 3-year loan is up, and we have 2 options. Well, 3. We could sell. And if we sell, we'll have a significant loss of equity, because, like, let's say we bought it for 40 million and we have 12 million of equity and a $28 million loan. If we sold it, we'd sell it for less than 40 million. So we'd be able to pay off our $28 million loan, but maybe we only get 6 million back. So that's not why we got into the deal, so we could lose 50% of our money. But if we sold, that's where we might be. Okay. So we evaluate a sale. And how do we do that? Is we get broker opinions of value, and they know what it's kind of worth. And we have a debt provider say, hey, what would this be worth? And so we could size up the deal for selling it today. So we look at a sale, and that's option 1. Then we look at a refinance. Now, the ideal model is you buy it, improve the value, and refi it and pay off the old loan and get extra proceeds, which is called a cash out refinance. But right now, what we're saying, and again, let's say we bought the
cash in refinance.
Yeah. So let's say we bought the deal at 40 million and it's only worth 35. Well, we might not get a new loan at 28 million. So if we paid off the $28 million loan, and let's say we only got a new loan at 25 million, now we got to put 3 million in. So that's another option that people are faced with. Or it could be like, hey, let's go back to the current lender, and we have a 3-year loan, but all these 3-year loans, Tom, they have an option to extend, but you got to qualify for them. And so like right now on a deal that I'm in, we were working on a refi, and it would have been some cash in, not a huge amount. It might've been $1 million or 2 cash in, but on our plan B, we were working with the existing lender, and they just notified us that we qualify to extend the loan. So extending it for 1 more year and keeping that loan, say, at 35 million instead of 32 million, and putting 3 million cash in, it's a better decision for us. Now, again, you could say, hey, well, what's going to happen in a year? And again, we could project what's going to happen a year, but we can't promise what's going to happen a year. Like, we don't really know.
Well, and it's interesting. You mentioned earlier that you see some stability coming up. Some of us see instability coming up. We could be in World War III in a year.
It could be.
Okay. I mean, we've got what's going on in Israel and the Middle East. We've got what's going on in the Ukraine and Europe. And now we've got potentially what's going on in China and Taiwan. So if you look at that instability, how do people tend to protect themselves during periods of instability? And if you're protecting yourself, what we had in 2008 and 9 is we had a lot of families that were doubling up. So we actually saw rents go down considerably in 2008, 2009. Even though you had a lot of people coming into the rental market because they were losing their houses. And so, and yet you still saw rents going down because you'd have 2-3 generations in a single apartment. So, how do you deal with that kind of projecting out? And what are you looking, what I'm looking for, Brad, is what are you looking for does this have legs? Are you just pushing, are you thinking, I'm just going to push it down the road and hope for what's best? Kick the can down the road, which I think some developers are doing, frankly, or are you looking at the kind of the fundamentals of the deal and the place and saying, look, these fundamentals are strong. The rents are going to be strong and it's just an interest rate thing.
Well, we're doing the latter. So like if the deal is in a path of, say, progress. And so what is progress? And one of the things I look at is like, are jobs growing in this area and are they projected to grow? Are people moving to this area and is population projected to grow? Who are those people? Are they Goldman Sachs that's building a new headquarters in Dallas where people are going to make $350,000 a year? And is there enough housing for them? Are they, middle income jobs? And so understanding that and looking at these patterns of employment, wage growth, population growth, I call it like the path of progress versus the opposite. And so we could look at that data and we could project out. And again, I've been doing it 22 years and I'm not always right. But
so you'd look at it like it's a brand new project.
Yeah. So like if you're going to, like, and I tell the investors the same thing, like, one of your questions is like, well, what would you tell the investors? And as you know, I mentioned I'm in this situation with myself on a handful of deals that I'm involved with, but I'm also a coach and mentor to like thousands of other people. So what I tell them is like, reevaluate the deal as it is today. And, first of all, some people don't have the liquidity to invest, they're tapped out. But if they do have it, then it becomes like, to me, it becomes there's the numbers and then there's also like other things besides the numbers. And I'm just, I could talk about that. Some people it may not align with, but like, I mean, look, well, I'm going to go ahead and say it. When we had a decade of record breaking profits, nobody came to me and said, hey, Brad, you did a great job. I want to give you more than, what we've agreed on. And I didn't do that to my GPs either. As an LP, if I was projected to double my money and I 4X'd it, like I didn't say, hey guys, like I want to give you more. And so part of it is like, but it does come to the numbers, like it does. And I just want to, like, it comes to the numbers. If you believe in the deal, if it's in the path of progress, if your contribution could save the deal and contribute to turning the deal around where everybody gets their money out, and the alternative is everybody loses their money, to me, it would be a shame to let something go that's in the path of progress, that's going to perform based on reasonable, projections. And it's also an understanding of, there's seasons to everything. There's market cycles. And you talked about 2008 and 9. And I could also say this, I was actively investing in real estate in 2008 and 9. And it was tough back then, but I wish I would have bought more in hindsight.
No, I understand that. Yeah. This has been a really good analysis, Brad. I appreciate that because I'm always telling people, you've got to run the numbers, and I think you've done a really good job of explaining that. Let's go to we've hit the hard stuff. Let's go to what markets do you see that are not? I always worry about boom markets because, of course, I live in Phoenix. It's been a boom market. There's Las Vegas that's been a boom market. Houston, I remember Houston in the 80s was a boom market and then went completely bust. What markets are you looking at that you go, this is not a boom market, this is a consistent market where we see consistency over not just not just in the last couple of years, but actually over 20 years?
Well, I love this question, because I've been doing it 22 years and I always look at the numbers. My background is MBA engineer. And so yeah, Phoenix has been a great market, but it's also been more cyclical, like
Right.
more up and down. And on average, it's been a great market. But that's like saying the average family has 2.4 kids, but
Right.
so look, if you're in it for the long term and you're committed to the market and that's where you're going to grow and specialize in and build your infrastructure, Phoenix makes a lot of sense. But my model is to buy a deal, improve it, hold it, and exit it within 3 to 7 years. And so there could be times where you're caught in the cycle. And so, I started my real estate investing career in multifamily in Houston, but in 2008 pivoted to Dallas because it occurred to me that Dallas had less fluctuations. Like Dallas has a more diversified economy, for example. And so I've done well in Houston, but it's when you look at markets like Phoenix and Las Vegas compared to Dallas and Tampa, Tampa has been relatively stable, but Tampa still has more ups and downs than say a Dallas, but has a lot Central Florida has a lot less up and down than say Southern Florida. There's a lot of speculative building and speculative buying. And whenever I see an area where the land is worth more than the improved value, it kind of concerns me a little bit. I've never bought a deal in Austin. I could have made millions of dollars if I would have went all in on Austin, but it's kind of a boom market and I don't know if it's going to stop. And it's had some challenges. And so I like to look at markets that have had a long-term track record of consistent growth with less downturns, or when there is a downturn, they're less severe. And so you just see less severe peaks and valleys in terms of economic performance. And so usually that lends itself to economies that are cities that are fairly large, that have diversified economies.
So let's talk, let's shift a little bit away from kind of the markets, but now that you're talking about, okay, what are you looking for? Let's talk about what do renters look for? So when a renter is looking for, where do I live? Okay. What are the top 3 things that the renters care about?
Well, let's define 2 classes of renters. There's renter by necessity, and then there's renter by choice. So Tom, as you know, I rent in Dallas and I rent in, Florida, and I'm a renter by choice. And so I'm looking for I'm less price sensitive and I'm looking for location and walkability and amenities and all that type of stuff. But renter by necessity is I'm more in the market of renter by necessity.
Right, which is workforce housing, right?
Yeah. So my target renter, makes less than 70,000 a year. They make between 40 to 70,000 a year. And so they're a little bit more price sensitive. So they're looking for value. They're looking at the size of the unit versus the price of the unit. So price and price per square foot, but they also care about curb appeal, and they care about the amenities. They care about the customer service, the swimming pool. So they want amenities, they want clean, they want functional, they want safe, but they care less if their building has a roof that's flat versus pitched. They care less. I'm not saying they don't care, but they care less about that. And because so what I do is I might buy a 1980s building, and even within that 1980s building, and let's say it's 100 units, I might upgrade 50 of the units with better appliances, better flooring, backsplash, better fixtures, and those units might have $150 rent premium. But I also have to understand that in that income level, not everybody's going to want to pay $150 more for all that stuff. So what I like to offer is a classic unit, which is a less renovated unit that might just be clean. Someone moves out, let's put in new carpet, a fresh coat of paint, make sure everything is working. But they may not get the brand new black appliance package or the stainless steel appliance package or the quartz countertop upgrade. But then there are people that are going to want that. So like, even within that property, we're going to have different product and price points. And so, and sometimes we'll test it, Tom. We'll say, hey, I'm going to upgrade 10 units and charge 200 a month. And I get all 10 rented and say, and I'll say, hey, let's do 10 more,
So in that group, what percentage of those renters are working from home still? Because of course, during COVID, everybody worked from home. And then after COVID, there's been a lot of people wanted to stay working from home. In fact, my wife and I were in San Diego a year ago, and we were seeing how busy the surfers were on a Wednesday afternoon. We go, oh, those people are working from home. Just chuckling about it.
Hey, in California, Tom, they may not be working. They might be being paid to stay home, and that's why I don't invest in California.
Right. So my question for you is: are you seeing a shift there? Do those renters in workforce housing, do they work from home, or are they coming back to the office? And so does physical location and how close they are to the work, how important is that now versus say in 2019?
Well, I think it's important, but I think that, look, I think in the white collar arena, there's probably more work from home people. And let's just say in the blue collar arena, there's compared to white collar less, meaning, look, like if you're a waiter at a restaurant, it's hard to work.
You have to go, right?
Yeah. And so the tenants, or if you work retail, I'm in a hotel room right now. I'm looking down on the street in West Palm Beach, and I see the Restoration Hardware. These people are not, unless you're the general manager, you're not making $150,000 a year. If you're the person on the floor, and maybe it's a spouse, their spouse might have a higher paying job, but let's just say you're, a single parent or a single mom and you have a job in retail or whatever, like you can't work from home, like you're going to go to work. And so I think that in the workforce where there may be a higher percentage of 5 years that are working from home, but it's not the same as white collar. I think more people are still.
So location for them and proximity to, for example, I know some developers who particularly like to be near military bases. They like to be near, they not like to be near medical facilities. They like to be near factories because it's convenient for the workers.
Yeah. Well, one of my recipes for success in workforce housing is one that I did in 2001, actually, and have a variable rate loan. And we actually did something really rare. We just did a cash out refinance on the Spring Valley apartment deal. But that property is located literally next to an elementary school. And that matters, and there's 2 churches across the street. So one of the things I look for is are the things that the people need close to their residence? And are the things that are close to the residents going to make the place a better place to live or a worse place to live? Like I always say in my seminars, Tom, you don't want to buy the property next to La Discoteca. You'd rather buy the property that has the school and the church close by. It doesn't even have to be your school and your church, but schools and churches, and then single family homes that are nicer single, like at the Spring Valley Apartments, the single family home community across the street are relatively new construction homes that are $300,000 to $400,000, and they're not let me just say crappy or rundown single family homes with burglar bars on them. So there's a livability factor in there, and it's hard to rate that, and that's why it's so important for multifamily investors to get to know their markets and physically go there. And even if you're an LP, every deal I invested in, I actually went and saw the property at least once. Even as an LP, there's a formula, and there's never a guarantee of success, but there's a formula of things that are more effective and that are, that work better than things that don't.
Well, and I presume you get a feel when you actually go there that you can't get. One of my favorite commercial investors was Rusty Lyon. Rusty Lyon Westcor it was a commercial real estate developer years and years ago in the Phoenix area. And he actually was the first one in the Phoenix area to have a helicopter so he could actually look and see what was going on in the surrounding areas because he was a mall developer. And so, I'm sure that having some feel for it is important. This has been super helpful, Brad. I'm going to turn to one more thing. I'm going to ask you to get your crystal ball out. So crystal ball, it sounds like the Fed's going to reduce interest rates a little bit. What do you see though for the next 2 to 3 years? What's your prognostication?
Well, I'm always honest, so I hate to say, let me be honest, but like I read and study a lot of forecasts and reports. So like what I mean to say here, Tom, is this is not just like an emotional gut feel that I'm about to share. It's something that's based off of, I look at all the major brokerages. Like before we came live, I was showing you a report from, Houston, and then I read the Marcus Millichap reports and the CBRE reports and the CoStar reports and the Real Page reports. And so I consume a lot of this because this is an industry that I'm committed to and been committed to for 22 years and will be committed to for at least the next decade. But everything I see is like, and here I am at a Tony Robbins event, and he talks about, seasons of industries. And so like, look, we're in a winter season, and so I don't know when the full spring and summer is going to be, but I know that it's coming and I'm getting ready for it. And I'm seeing some of the signs. Okay. I'm seeing some of the signs, like when Blackstone buys billions of dollars worth of multifamily, or KKR buys billions of dollars worth of multifamily, and it's harder to raise money now. That's what they say, but that doesn't mean there's no money. Like you said, people are just a little bit more gun shy. And so there's like billions of dollars of dry powder on the sidelines. And so like what I see and believe to be true based on, number one, my 22 years of looking at past patterns and what happens after a downturn, and also looking at forecasts, is I think we're coming into some pretty good times. There's strong fundamentals in multifamily. There's big affordability gaps between the cost of a working class family buying a home and their PITI payment versus the median price of renting an apartment. And so I look for markets that outperform, like have the fundamentals of like job growth, population growth, affordability gap, landlord and business friendly. And so look, there's risk in anything that you do, but I think there's some good times coming. And there's a lot of variability. Like you said, like the election brings instability. Like I remember 2016, it occurred to me that Hillary was ahead of the polls and was supposed to win, like by all predictions. And I was closing a deal, Tom, and you actually did the taxes for this deal. It was a deal that I did, like a Kelly Crossing deal that I did with one of my partners at the time. And we did 5 deals together. And we had not yet locked in our interest rate. It was a fixed rate loan. And when Trump won, like we actually locked in at 100 basis points higher than we underwrote the deal, because the capital markets were really concerned that Trump was going to like hit the nuclear war button or something like, early in his presidency, but it didn't happen. So I believe, based on like going through multiple elections with, George Bush and Obama and Trump and Biden, that, usually there's some uncertainty and instability after election, but then things tend to calm down after the election. So I'm looking at a little bit more stability and certainty from the financial markets and capital markets. Depending on who wins, there could be different policies with economic policy and stimulation packages or taxes and all that kind of stuff. And so that can have an impact. But whatever the impact is, I think once it's known, there's going to be a little bit more stability. And I think we're rolling into some good times. Now, that being said, you hit on some great points. There could be civil unrest. There could be war in the Middle East. There could be an expansion of war in Russia and Ukraine. There could be a lot of things that throw things off. Like, who knows? Like, there could be a whole government shutdown and nobody thought that would ever happen. So like, but if you just look at the patterns that have happened in the past, and the forecasts that I see coming forward and where I believe we are in the market cycle, which is in a downturn of the market, I see a lot of opportunity and upside.
So final prognostication here. If you look at and you compare and you go back to, because you were investing in 2006, 7, 8, 9, and 10, and we didn't actually see the market really turn till 10, 11. It crashed hard in 8 and 9. It kind of stayed there for a while, and then 11 we started seeing it come back out. Where do you think we are compared to, if you look at those years, where would you place 2024 from a real estate market standpoint?
I mean, I would say like we're almost like 2 years in, like we were at a peak, say 2 years ago of, you know, Q3 2022 was where things kind of peaked. And so can things get a little bit worse? They could. But I see like things coming out of the peak in the next.
We're a lot closer to 2010 than 2008.
Absolutely. I was going to say, I think we're in 10 or 11, you know, I'm not sure. And
Okay.
I may be wrong, but I think we're coming on. I mean, look, I think we're in 10 or 11.
All right. Thank you. So,
and I would have bought more, Tom, in 10 and 11, by the way.
Yeah, for sure. Of course. You know, I mean, that's the interesting thing about markets. It's really bad for the sellers, but it's really good for the buyers, right? I mean, if it goes on sale, I mean, if prices have come down that much, that's good for the buyers. Right. I mean, especially if interest rates continue to come down, of course you can't, and it's really hard to anticipate that. I think that's a losing proposition to bet that interest rates are going to come down. But if you can make the project work with the interest rates as they are, and they do come down, which is exactly what happened right in 11, 12, 13, is that people did, you know, those who bought well, they were okay with the interest rates as they were. And then the interest rates came down. And so they would double their money just because if an interest rate goes from 4% to 2%, you doubled the price of the property, right? I mean, your cap rate's doubled, your cap rate's half. So your property value is doubled. So I think the fundamentals, I think you've really given some good advice here, Brad. Go to the fundamentals and really look at those markets and those locations within those markets, you know, that have that long-term sustainable growth. And I think that's great. So if you could leave us with, if there were like 2 things that you think investors should be doing right now, even in preparation to invest, what would you have them do?
Well, I think it's like what I'm doing here. You know, I'm at a conference. The best investment you can make is not in any type of property. It's not in any type of building, and it's not in any type of asset class, but it is in real estate, but it's the real estate between your ears. And so no matter what you want to do, you know, invest, like Warren Buffett said it best. He's like, the investment you make in you is always going to have the highest ROI. So like, I would say like, you got to have like your ducks in a row. You got to be ready. Like I have my pencil up, not down. Like I'm looking at deals right now. We're making offers this week on 3 properties because I see the opportunity. But before you can make an offer, like you got to understand the fundamentals. You got to have your markets selected based on data. Like where are you going to buy? What are you going to buy? You know, who's going to be on your team? Are you going to buy the deal yourself? Are you going to syndicate the deal? Who's going to be your real estate syndication attorney? Who's going to be your lender? Where are you going to get insurance? So like, you don't have to have all these things defined before you get started, but you want to start working on it. You know, like Stephen Covey that I studied, you know, before he passed, but I read his book on the 7 habits of highly effective people. And habit number 6 was sharpening the saw. And I think it's time for people to get their saw sharp.
I love it. Get your saw sharp. You know, develop your own strategy for investing, which I think that plan of action is so important. So Brad, I know you've got an event coming up at the end of September. Go ahead and let people know when and where it is, how they could get there.
And Tom, that's why I do events, by the way. Like I started by going to an event and I was the skeptical engineer in the back of the room. But somehow, what the guy said back in 2001 when I went there made sense. And I went out and took action and I got ready. Like I did what I just said. Like I invested in myself and I got ready and I had a real estate mentor and I was associated with a community of like-minded people, which is where I raised equity from. And so I do events because it's, it worked for me. And I'm actually at an event attending one right now because I learn and I network and I meet people. So yeah, my event is our 7th annual Apartment Investor National Conference. It's for people that are investing in apartments or that are curious about investing in apartments. We teach a proven framework, a proven system on how to find and fund and manage deals. But more than that, we have 8 amazing speakers. And none of these speakers are paid celebrities that, people do these days to put butts in seats, so to speak. Every single one of these people are content, heavy people that are in the industry, and you're one of them. And I got like Charlie Young, who owns 20,000 apartment units. And I have John Chang, who's the senior vice president of Marcus and Millichap. And we have Neil Bawa, the mad scientist of data from multifamily, lots of great content speakers. And so as a result of attending this event, you're going to learn from each and every speaker something useful that can move the needle. And we have structured networking. We have industry experts, attorneys, lenders, insurance providers. So the 3-day experience is really designed for people who want to grow their multifamily business or get into it and get off to a successful start with the right tools and strategies.
So when and where?
Dallas, Texas, September 27, 8, and 9.
Okay. And where would they go to get more information about it?
Well, they could go to bradsumrock.com, BradSumrok.com. And then there's an event tab. And, or Tom, if they, I don't know how you put this content out, but if they comment on it or send something to you or to me, like we could get them QR codes and links and all that type of stuff. And Tom, I'll send you, how about after the recording, I'll have my team send your team like a link or a URL, and we'll even give someone like a promo code with like Tom W on it where they can get a discount.
Sure. That sounds great. So just remember, Brad's doing the event. This is not about Brad's event. This podcast is very much, I love that Brad does events because he does such good education, but this is really about what's going on in the market. What do you do now? How do you evaluate? I think we've learned so many great things. And if you've enjoyed the content, if you've really enjoyed if you've learned something like I have about evaluating your investments or evaluating new investment, looking at the real estate market, please click like below. Please, subscribe to the channel. We have other great podcasts and YouTube videos that are with amazing guests like Brad. And remember that when you do get sharpen the saw, as Brad says, and when you do actually learn the fundamentals of investing, you're always going to make way more money and pay way less tax. We'll see everyone next time.
Thanks. I love it.
This podcast is a presentation of Rich Dad Media Network.